So in our PWAPs, you got to stay with me if you're not familiar with our PWAPs, stand for position weighted average price, sample size of those that are long and those that are short. And we compare them to each other. And then we take an average of those positions and size the contracts and what price they're long or short from, and then put a line to say this is the average price of where people are long or or short from. Red for shorts, green for longs. That's important because that's where the market essentially is long or short from over the last 60 minutes, by the way. So when you get less longs higher, okay, it's just people aren't getting long, and then the longs from below are carrying more weight, then the PWAP's going to drop. When there's less longs, just remember if longs equal sellers, future sellers, then less longs would equal what? Less future sellers. That's all. So if indeed you have less longs and you're able to declare that, less sellers is always what the price of anything needs to go up. If you have a lot of people that are interested in buying a home in a subdivision and nobody's selling that home, well, when you finally get a seller, he's going to ask for a little bit more, or they're going to bid through his ask price. The price of everything needs less sellers to go up. And so if we just play this, we see the dip in the green PWAP, which is showing nothing, just goes blank, which is showing less longs above. So just watch this right in here. You see it already run up a little bit. Boom. It gives you the next right side. It gives you a better bias with a higher probability, but it gives you a precursor to it. It's not after the fact. That's not a good tool. It has to have a little preview in order to have predictive value. You can't say, hey, I think it's going to rain after we're wet. It's not even valuable to say, I think it's going to rain when you hear thunder and see gray clouds. That's not that great of a prediction, right? But to be able to say, I think it's going to rain in 10 minutes, and you look up and skies are clear, you don't hear any thunder, and all of a sudden something happens, it starts, that's a great, helpful prediction. That's what you need more and more in your trading. And so just the idea of understanding less longs and more shorts and all these combinations that aren't that complicated because you start with the premise of longs versus shorts. Just keep going back to that. You know what I mean? So where do sellers come from? Sellers come from longs. Where do buyers come from? Buyers come from shorts. When you work it backwards, you start asking the right questions. You start asking better questions to give you better opinions, better ideas. If your opinions are really good, then it's easier to work on locations to get on the team. You know what I mean? So all the entire progression of trading is important. When people have come to me and said, which one's more important? They're all important when you're risking money. Every element and every part of it is going to be important. Some days it's more important to be in a step one better bias. Other days, just it's the location. But again, all of it's important. Ready, aim, fire. The whole progression is important. And then once you've seen the market, the longs step up, meaning the PWAP, the green PWAP, start to head up, that was some predictive value in a top. Let me back it up. You got to know when it starts to go up. You could say it starts to go up right there, right? You see a little V shape down here. So watch price. Price goes up a little bit more, but ultimately it's a top. That's a top. You've seen the V before the top. If your tools aren't giving you a little bit of a precursor, a preview, they're not great tools. They're late. They're lagging. You're wet, and then the guy says it's going to rain. Thanks. So it just, for someone watching this video for the first time, it's like, what the hell's a VWAP, PWAP, all that? And I get it, but if you understand, and hopefully you understand some foundational elements to trading if you have a trading account, but you just get into positions. There are longs and there are shorts. And if you start understanding that, future sellers generally come from long positions and future buyers generally come from short positions because you have to cover that position, then you start saying, well, that's what I'm trying to do. I'm trying to find future buyers and sellers if I'm trying to predict where price is going. And if you're an investor or a trader, I don't care what your time horizon is, you're trying to predict where a price is going. You're not going to buy, even if you're investing in Apple, you're not going to buy Apple today if you think it's going down tomorrow. You're going to wait, even if you're going to stay in it for 20 years. If you have an idea, it better have, or if you have a tool, I should say, better have some preview value in order for it to have predictive value. That's all. So you could see these crosses and what they do. But, you know, the support and resistance that these lines have, the best that I've been able to find, and I always tell people, find out for yourself. Don't take my word for it. But when you see a transition in the market, like when they finally get through this area, it's generally in this case bearish to bullish, B to B we call it. They make great transitional moments where it's going to give you a better idea because you're above or below them, but just imagine, just know the value of other people's positions, OPP as we call it. Stop worrying about whether or not you should get long or short and try to figure out if the market's long or short.